All right. So you wrote a book called Tax Strategies for the Savvy Real Estate Investor. It's a very well-known book in the real estate community. And in your book, you discuss the use of self-directed IRAs for real estate investments. Can you elaborate on how individuals can leverage those self-directed IRAs to invest in real estate syndications while taking advantage of the tax-deferred or tax-free growth?
Yeah, I mean, it's definitely something, an area that a lot of our clients take advantage of. Taking kind of a step back, I think the way to look at it, obviously, people are, they have retirement accounts, they're going investing, and most of the time people are investing in stocks, bonds, mutual funds, but it's not stuff that they can control. It's not stuff that they know necessarily. It's just putting it in the hands of somebody else and letting whatever happens, which is fine, obviously. But the way we talk to our clients about it is a lot of our clients, probably 85, 90% of our clients are involved in real estate to some extent. So that's their knowledge base, right? So we talk to our clients about looking at why not use your retirement account to invest in something that you understand and maybe to some extent can control. You have a better grasp on that market than the mutual funds, right? Now, whether you've got your money in your IRA already, whether it invests in stocks, bonds, and mutual funds or real estate, really comes down to where do you think it's going to get a better return on your money. That's one thing. And then again, clients seem to understand the real estate side of things a little better. So that's why our clients like to use their IRAs or retirement accounts to invest in kind of alternative assets, as we call it. But at the same time, they're still, they can still put money into the retirement account, potentially take a tax deduction when the money goes in. That money will grow tax deferred as it investing. And then depending on what type of account it is, when you pull it out, you may pay taxes or you may not if it's a Roth. A couple different ways to slice it and dice it, I guess.
So one of the challenges I know you sometimes face investing in real estate with an IRA or any kind of retirement account is UBIT, unrelated business income tax?
Income tax, yeah.
Yeah. Can you describe for people what that is and maybe some strategies for not getting hurt too bad by that?
Yeah, UBIT is one of those quirky things in the retirement world where if your retirement account invests in certain types of assets, even though it's a quote unquote retirement account and it's supposed to be tax deferred or tax free, if it's investing in certain types of assets, then it may pay taxes along the way. So one example outside of real estate would just be like, I don't know, if your retirement account invested in a Subway franchise or something, it was one of the owners that was, it was set up as a partnership and your retirement account was getting a K-1 because they were operating a business. That type of income in your retirement account, your K-1, would be subject to this UBIT tax. Now, in the real estate world, retirement accounts that they invest in what they call leveraged rental real estate, those are situations where the retirement account, if the rental property is kicking off a profit after doing the normal expenses and depreciation, if there was a profit, then their retirement account may have to pay a tax on the kind of debt finance or the leverage part of that profit every year. If you buy a property for $500,000, there's a loan of $250,000, there's 50% leverage in that situation. So any dollar of profit that rental property would make, the IRA would have to pay 50% of that would be subject to this kind of UBIT tax that you were referring to.
Yeah, I think the one thing I want to add is a lot of people or a lot of advisors actually recommend or try to have people stay away from using retirement money for real estate. But something really important to know is that UBIT taxes is assessed on taxable income. So you can use things like depreciation and things like that to offset the current tax. So we really don't, in practice, that becomes a problem usually sometimes later on in the life cycle of an investment or upon the sale, right? When you have a property, you sell at the very end for a larger gain. But I think like Matt said earlier, it's really about comparing the total return on investment, right, after factoring in the tax costs, rather than just saying never use retirement account for real estate.
Yeah, that's often what I tell people is, I'll have to pay UBIT. And I'm like, do the math. There's depreciation. You're probably still going to end up with a better return than you might end up with investing in the stock market. It's kind of how I look at it.
Yeah, that's exactly. You look at the math, it's like, hey, my return on investment was 5% in the stock market, in the mutual funds. And after, even if I paid UBIT and my IRA's return on investment was 7%, obviously you still came out ahead, right?
Yeah. It's just sometimes people, they're overly tax sensitive. I don't want to pay any taxes at all. You're stepping over dollars to pick up dimes or what it is.